Good day, everyone. Welcome to our webinar for June month 2019. It's been a very interesting and exciting month with the elections and what have you. But I'd like to begin in the United States and just take a look at what's going on over there. And to say that the average opinion of investors generally is discounted into the markets. I think we need to start off with that understanding. The indexes of the markets, especially indexes like the S&P 500, represent the average perception of investors worldwide about the progress of the American economy, and particularly the 500 very large companies that make up the S&P 500. So the S&P recently reached a record high at 2945 about a month ago. And this was based on the growth in the US economy. In the first quarter of this year, the US economy grew by 3.1%. Which might not sound like a great deal, but for such a large economy, it's massive. It's a massive growth for such a big economy. And it easily beat the forecasts from analysts of 2%, beat them by more than a percentage point. A good chunk of that came from private consumption expenditure, which means that ordinary Americans are basically spending money. They're spending money. They're going out to the shops. They're buying things. In April month, the US economy generated 263,000 new jobs, again beating the forecast, which was 190,000 new jobs. The unemployment level in America is at a record low of 3.6%, and hourly earnings are at a record high of $27.8 per hour. That's the record for average earnings in America. So then, the question then is, why is the S&P falling? Why is the S&P 500 falling? Well, of course, the answer to that question is Trump's trade war. It's unnerving investors, and trade wars never make any sense. They don't make any sense. No economist will ever say that there's a benefit to be gained by anybody from a trade war. America is not gaining from this trade war. It's losing. And that is clearly represented in the S&P 500. Trump has put tariffs on $200 billion worth of Chinese goods. And now he's added to that a 5% tariff on Mexico, effective from the 10th of this month, June, unless they can stop illegal border crossings. Well, obviously they're not going to be able to stop illegal border crossings, so that 5% tariff is going to go into effect. And Mexico has more than $600 billion a year of trade with America. So that's going to hurt American companies as well as, of course, Mexican companies. And the point that is made here is that if they hurt the Mexican economy in this way, surely that will simply result in more illegal immigrants trying to cross the border and get into America. That seems to make some sense to me. More than that, of course, Trump wants to increase that 5% tariff to 25% if they are not effective at stopping border crossings. It's really a mindless policy that shows no knowledge or understanding of how economics works. At the same time as doing that, he's also increased the tax rate for Americans by some $200 billion a year. And the US-Mexico-Canada agreement, which is called the USMCA, is now in jeopardy. So all these things have made the S&P 500 fall. Investors have become nervous, and they are selling off big companies in anticipation of some kind of recession, stimulated by their own president. So the question you have to ask as a private investor is, can this derail the boom which has been going on in America? We think not. We think that what this is really is Trump trying to turn attention away from his possible impeachment and his other legal problems with his tax returns and so forth, and with the Democratic Party. We think that he is simply diverting attention and news away from those things. The S&P 500 is now down by 6.5%. So I'd like to just go to that chart. Okay, there is the peak. Well, in fact, that day there is, the earlier day. This is the peak at 2945.83. That's the highest closing level of the S&P 500 throughout time, and you can see it happened about a month ago. And since then, we've come down through various resistance levels. So there was a resistance level here at 28.01, which was touched 3 times and then finally broken. Then the next resistance is at 27.42, and you'll see here that we closed last night just above that at 27.44. And then below that, the next resistance after that is 26.92. And then you can see how I establish these resistance levels by where the market has fallen to on the upward cycle. Now, of course, one of the things that's been upsetting investors is that the Dow Jones Industrial Index has made a triple top formation. Now, triple top is quite a scary formation. It's one of the most bearish formations you can get. And so some investors who follow the Dow Jones are looking at this. Let me just put a little bit less data on that screen. At this triple top, which I show you here, and you can see there are the 3 tops. The first one taking place in January of 2018. Then the next one over here in October, and then finally a third top, if we rate this as a third top, right now in April, just a little while ago. And you can see after the third top a big sell-off, and we're down here now. But the problem with the Dow Jones Industrial Index is that it is a simple average of the 30 largest companies trading on Wall Street, a simple average. So it's not weighted for the market capitalization of those shares, which means a very big company amongst those 30 shares has the same impact on the Dow Jones as the smallest company. So we prefer the S&P 500. That is what we prefer. If you're going to do analysis of Wall Street, then we suggest that you rather look at the S&P 500 than the Dow Jones. So let's go back here and have a look at the S&P 500. Now you can see the same sort of triple top formation at the same times, because of course the S&P 500 differs from the Dow Jones only in that it is the 500 largest companies traded on Wall Street, and it is weighted for their market capitalization. In other words, the bigger shares have more impact than the smaller shares. And you can see the triple top, but it's what we call a rising triple top, in the sense that each top is higher than the one before. And that is considerably less scary than a falling or flat triple top such as you see in the Dow Jones. And here again you can see where I've picked up these support levels and how we broke through the first support level at 28.01. We're now down here looking at testing this 27.42 support, and then below that we have 26.92. We don't believe that this downward trend will persist very long. We think it is a artificially created downward trend, and that as soon as Trump loses interest in his trade war, or loses interest in trying to hammer the Chinese, or something else, or gets deflected by something else, then you will see the situation recover very quickly in America. Why? Because of the enormous growth, the very low unemployment, the very strong results that are coming out from the S&P 500 companies. Very soon, if something like that happens, if the trade war fades out over the next few months, which we believe it probably will, then you're going to see investors piling back into those S&P 500 companies as they recognize them to be cheap, and they will be. Then this third and final record high over here will be broken to the upside. So that's our view. Before I leave the subject of America and the American situation, I mean, you might decide that you want to sit on the side, that this is a risky, scary situation, and you want to get out of your investments, sell out and move into cash and sit on the sidelines and wait for developments. Nothing wrong with doing that. It's a safe, solid approach. But then you might find yourself sitting in cash when the market breaks to a new record high. So you just have to bear that in mind when you're considering this. I mean, another perhaps more radical approach would be to treat this as a buying opportunity and to increase your investments at these lower levels. One thing that's interesting about America, I'm always trying to see what's going on, especially with new technology. One thing that I've discovered is that there are now about 30% of the American workforce who are what are called gig workers. In other words, they are part-timers, freelancers, people who work on short contracts, people like Uber drivers, people who are doing foreign language teaching over the internet. About 30% of the entire American workforce is not employed as such, but they work for the company or a group of companies, and they work for them on a part-time basis, some kind of contractual basis. And that, of course, is very nice for those companies because they don't have to provide them with medical benefits and pensions and all sorts of other things. They're just on a contract. So these gig workers, as they become called, are mainly employed by the FANGs, what are called the FANGs, which are Facebook, Amazon, Netflix, and Google, and other high-tech companies like that. They love to employ people on this base. So they've got a small group of permanent employees who are in management. And then the vast majority of their employees are people who are YouTubers or people who are Googlers, and they make their living off the internet or off some sort of contractual arrangement with one of these big FANG companies. It's just interesting to see that because it shows you how things have changed in America. And when things change in America, they inevitably end up changing here as well, sooner or later. All right, let's turn our attention now to South Africa. And I want to talk a little bit about the political situation. Obviously, we've had the election. The ANC was returned, perhaps with not as big a majority as they would have liked, but nonetheless with nearly 58%. Ramaphosa has chosen his new cabinet, and that new cabinet initially was very scary for some investors, particularly overseas investors, when they realized that David Mabuza was going to be the deputy president once again. But on consideration, it appears that this new cabinet is a really good compromise. It indicates, of course, that Ramaphosa is still vulnerable to the opposition to him in the ANC, within the ANC, and he's had to make certain compromises. But he's also done a great deal to clean up the image of the cabinet and reduce its size. He's got people out of there who were clearly not well suited to being in the cabinet. And he's retained the people who are the fixers, the people who are fixing things in the South African economy, like Pravin Gordhan and Tito Mboweni and so forth. So we believe that it's a good compromise and that will reflect itself in economic growth sooner or later. And of course, now that is behind us, that election is behind us, we need to start addressing the real structural problems in the South African economy. The Business Leadership South Africa leader is a chap called Busisiwe Mavuso, made this observation. He said, Labour has been allowed to run amok in South Africa. That is a very, very interesting remark coming from somebody in his position. We have been saying that for a long time, and we believe that Ramaphosa will sooner or later have to confront the unions. It's clear that he's already involved in cutting down the size of the South African civil service, starting at the top with the cabinet ministers. He's cut the cabinet down from 36 members to 28. That is a significant cut. Of course, his main problem will be Eskom. Eskom looms large over the South African economy. It's in a financial crisis which has to be dealt with, cannot be put off any longer. It has debt of 440 billion rand. And it's raising money now in the capital markets just to pay the interest on that debt. And that is really the definition of a debt trap, when you start raising money just to pay the interest. You can't repay capital, so you're raising money not to roll over the capital, but just to pay the interest. 45 billion rand of that debt must be repaid this year. So something is going to have to be done. The committee that Ramaphosa has set up to deal with this problem has proposed what's called a special purpose vehicle. And that special purpose vehicle will assume the debts, will take over the debts of Eskom and raise funds from the international community on the basis that South Africa is going to move away from coal-fired power stations towards renewable energy. There is quite a lot of money out there in the international community for anyone, government or private organization, that is involved in establishing renewable energy projects and moving away from coal. So they are talking about tapping into that source of funds, and of course that will mean that we have to move away from our coal-fired power stations. But I think that's a good thing. It's quite clear now that renewable energy is actually cheaper than coal. Even in South Africa, where we have a huge reserve of very cheap coal available to us, easily accessible. But even in this country, because obviously one of the reasons being our number of sunshine hours, we have a great resource of renewable energy available to us. At the same time that has happened, the Minister of Energy has now changed the rules to allow private companies in the private sector to build power generation up to 10 megawatts. Previously, they had to get a license for anything that was above 1 megawatt. And 1 megawatt is really not enough for most businesses. Now he's moved that to 10 megawatts. So now all sorts of companies can get involved in generating their own power and using obviously renewable energy, putting up solar panels, and they can even sell that power to other consumers, other private investors, private companies, and consumers, and they can get off the grid and get completely off the grid. Of course, this is bad for Eskom because it will damage their market quite substantially. But Eskom has to move away from power generation. They shouldn't be in power generation. That's where the problem has arisen. They should only be in power distribution. One solution to Eskom's problems was raised by the principal executive officer of the Public Investment Corporation. Now, you probably know that the Public Investment Corporation is the biggest investor on the JSE. They own, roughly speaking, 12% of the entire JSE. So if you go and look at Standard Bank or any big company, Bidvest, whatever, you will find that they are holding between 10 and 15% of that company's shares. So they own most of the blue chip shares. In fact, in many cases, they are the largest shareholder in most blue chip shares. And one of the investments they made a long time ago was that they bought Naspers shares. Now, those shares have obviously gone up very nicely, and their investment is now worth 202 billion rand. And the suggestion made by the principal executive officer is that they sell that Naspers investment, which will be very easy to sell on the international market, and they invest that money in Eskom. That would obviously immediately overcome Eskom's problems to a very large extent. It would cut its debt virtually in half. But the question, of course, is what kind of long-term return will Eskom provide for members of the Public Investment Corporation, for the pensioners whose money they are investing? And that has to be considered. But of course, as a solution, it has a lot to recommend it, except for the pensioners. They are the ones who are going to have to pay. But it's something that the government could do. They could actually do that. Okay, let's turn our attention now to the economy. Last year, the GDP growth was just 0.8%. And we've got tens of thousands of matriculants who qualified, got their matric last year, and they can't get jobs. In fact, on the job front, we're actually going backwards. This year, of course, the March quarter started off with 26 days of load shedding. In the second quarter, GDP growth is way down. It's a negative growth figure for the second quarter, almost for certain. The Reserve Bank itself has now reduced its expectation for this year from 1.3% to just 1%. So it means this year is basically going to be a repeat of last year as far as GDP growth is concerned. It's not nearly enough to deal with the rising unemployment in this country. In this regard, I was interested in the comments of Vikesh Ramsunda, who is the new CEO at Clicks. People like him, the CEOs of big, well-known listed companies, usually have substantial research at their disposal. So they are extremely well informed about what is going on in South Africa, and particularly obviously in their markets. So it's always worth listening to them if they make a comment. And Vikesh Ramsunda said that he expects that things will not improve in South Africa for the next 18 months, mainly because of the difficulties with Eskom. So that is something to think about. Of course, Standard & Poor's came out and they said that they were going to keep South Africa's status at BB and BB+. And that is a huge expression of optimism in Cyril Ramaphosa and his new cabinet. It's always good when an outside independent ratings agency basically says that we are doing the right kind of things. The unemployment rate, unfortunately, has jumped another 0.5% and is now sitting at 27.77%, nearly 28%. In the first quarter of this year, our economy lost 240,000 jobs. You've got to compare that with the American economy, which gained 263,000 new jobs in April month alone. We, in the first 3 months of this year, lost 240,000 jobs. And that comes back to what Busisiwe Mavuso, the leader of the Business Leadership South Africa, said. Labour has been allowed to run amok. Ramaphosa must tackle the labour problem next, even though that is likely to be very unpopular. So given the scenario that I've just painted, it seems quite likely that at the next Monetary Policy Committee meeting, which is in a couple of months' time, the Monetary Policy Committee is likely to reduce interest rates. I certainly think it's a possibility because the economy is very, very depressed at the moment. And at the same time, inflation is really low. We don't have any inflation really to speak of because there's no demand inflation. Nobody's got any money. That's really what it comes down to. On the good news side, the LNG, the liquid natural gas project in Mozambique, is going ahead very well. Standard Bank has just lent 20 billion rand to Andarko, the company that's doing it. And the idea is that they will benefit from a growth in Chinese demand for liquid natural gas as the Chinese move away from coal. The Chinese have got this thing about blue sky. They are trying to move to a renewable energy economy. And the demand for liquid natural gas is increasing. Liquid natural gas produces about half of the pollutants that coal does for the same amount of energy. The next thing that we have to consider is the rand. Obviously, with David Mabuza's reappointment as deputy president, the rand took a bit of a hit and it fell back as far as 14.87 to the US dollar. However, the subsequent strength of the rand reflects the realization amongst overseas investors that the new cabinet is actually quite solid. Most of the bad elements have been removed, and it's a cabinet which is ready to work. It's also a much reduced size of cabinet, having come down from 36 ministers to 28. And that makes a big difference. That shows that Ramaphosa is intent on reducing the size of the civil service in general, which is very good news for South Africa. And the rand has moved back to 14.45 this morning and should continue to strengthen. Obviously, it's going to be volatile in this post-election period, but mostly because of other factors. For example, the strength of the US dollar. Every time that Donald Trump does something, the dollar either strengthens or weakens, and that impacts on the rand directly. Also, what happens in other emerging markets like Turkey and Brazil and Russia and so forth also affects the strength of the rand. So probably a better indicator of overseas perceptions or international perceptions of the South African economy is the R186, which is our long bond. It's the bond with the longest maturity in South Africa. And the long bond is a good reflection of whether people perceive us to be very risky. Here you can see on the screen now, you can see the long bond, and you can see that it's been trending downwards. The yield on the long bond has been trending downwards. Now, normally, when the yield trends downwards, it's a sign of confidence. Overseas investors have confidence in the South African economy when the yield is trending down, and vice versa. In other words, they are prepared to buy our bonds for a lower interest rate, effectively, because they believe that there's less political risk in the country. And as you can see here, the yield has been trending down for some time, and that is a much better indicator of overseas perceptions of the South African economy. All right, let's talk about commodities. Particularly, I want to talk about platinum today. Johnson & Matthey has just brought out a report in which they are saying that they expect a shortage this year of 125,000 ounces of platinum. This, of course, is a change from last year. Last year there was a surplus of platinum in the market. A shortage will tend to cause prices to go up, should tend to cause prices to go up. And added to that, of course, the entire platinum industry is now negotiating with the unions in order to come to a new settlement. The most important of those unions is AMCU, and they have just come out of a bruising battle with Sibanye Gold, which they basically lost. And I think that will have a positive impact on how the platinum negotiations go. I don't think that the members of AMCU are ready for another protracted strike after what happened at Sibanye. And another factor, of course, in the platinum industry is the possibility of further load shedding from Eskom. The load shedding that we had, the 26 days of load shedding that we had in March this year, has cost Anglo-Plats and Lonmin about 2 billion rand. So it was extreme, and that's just two platinum mines. Obviously, they're two big ones, but that's just two platinum mines. You can imagine the impact of that load shedding on the economy at large. Also, the World Investment Forum says that we can expect this year about 2 million ounces to be recovered, of platinum that is, to be recovered from recycling of auto catalysts. So that's obviously also a factor in the supply and demand for the metal. The platinum price, if we look at it on the screen, you'll see that it's made a double bottom. And that is at about $800 an ounce, or just below $800 an ounce. Here you can see the double bottom. There's the first bottom in September last year, and then again in December. And it rose off that double bottom, but has now fallen back to this low point here at about just under $800 an ounce. Hopefully this is a triple bottom, and platinum will rise off this low level. Obviously, with mine closures and retrenchments in the platinum industry, we cannot really expect platinum to fall much further than it has. I think $800 an ounce, or around about that level, will prove to be the bottom. At the same time as these things are happening, in the mining industry, the housing and living condition standards have just been promulgated. And those standards are shifting the costs of medical and housing to people who've got mining licenses. So these were previously municipal responsibilities, and they've now been shifted by this piece of legislation, or they are trying to shift them from the municipalities to the people who own mining rights in that particular community. This will obviously have a huge impact on the mining industry. And the Minerals Council under Roger Baxter is opposing it very strongly, because obviously South Africa is already not a very attractive investment for overseas mining houses, and this will make it even less attractive. So if we want to bring funds into this country to develop the mining industry, we should avoid this particular thing. Okay, that's what I had to say about commodities. I'd now like to talk a little bit about what we can learn from Steinhoff. All right, and the reason I want to talk about this today is because Steinhoff finally produced its restated financials, and they've published them, and they show really a horrendous picture. They show a web of companies run by crooked executives, moving cash around from one place to another and overstating profits. And the point that you need to grasp here is that these crooked executives even managed to fool the top-class professionals in South Africa. People like Alan Gray, Coronation, the Public Investment Corporation, PIC, and so forth. So their financials, which everybody relied on, or all the big institutions relied on, have now turned out to be nonsense, to be smoke and mirrors. So all these big institutions thought that Steinhoff was a solid blue chip share that was growing steadily, and this was despite an enormous amount of analysis and effort that had been put into finding out exactly what goes on at Steinhoff. Now, I've done quite a lot of work on Steinhoff, and I wanted you to just take a look at what I've done here. Because the question you have to ask yourself as a private investor is, if these big institutions with their high-powered analysts cannot get to the bottom of something like this, then what chance does a private investor have? The answer is that you can protect yourself by using charting or technical analysis. So on the screen here you see a chart of Steinhoff going back for the last 10 years. And you can see that from this point here at the bottom of this trend line, which was in 2013, Steinhoff was generally seen by the institutions as a really good bet, a fantastic blue chip share that was growing very fast and good international interests. And this is covered by this trend line here, the rising trend. And all of that went very well until this point here. This was at the beginning of 2016, in about March. The share made a top and then fell back from that top. But there's nothing unusual about that. Normally when you get a new record high, it's quite common for the share to fall back from that record high. And then it went up. This is where you should have paid attention if you're a private investor. The second top here, it failed to reach the same high as it had in March. So in June, a little bit later in the same year, 2016, it failed to reach that same high. That failure is very significant. And if you are a technician, you would have then been on your alert. You would have seen how the share then retraced back further than it had the previous time and came back to touch this underlying support trend line here. From that level, it rallied again and made a third top, but this top was even lower than the second top. So what we ended up here with was three declining tops, a triple top, a declining triple top, which is probably about the most bearish signal you can get in technical analysis. You'll also notice that after this declining triple top, the share fell back on disappointment and cut cleanly through the trend line, the long-term rising trend line, and went down substantially, down to about into the 50s. From having been at around 90 Rand a share, the share fell back to about 50 Rand a share. You'll also notice, if you're a technical analyst, that what we're looking at here is a long, massive head and shoulders formation. This is the left shoulder here, you can see here. That's the head where the triple top is. And then the right shoulder is this sloping affair on the right-hand side. And then, obviously, if you've got a head and shoulders formation, you can draw in a neckline connecting the two low points of that head and shoulders formation. And finally, over here, in about November of 2017, the share broke through that neckline, which is generally regarded as the final technical signal you'll get before you have a major decline. and the major decline came a month or so later when Viceroy published their report on Steinhoff and drew attention to the situation. Steinhoff admitted that there were accounting irregularities, and Marcus Jooste resigned as the CEO. That combination of events caused the share price of Steinhoff to collapse from here, about 55 Rand a share, down to 5 Rand a share. And what is interesting about this is that the point that you really need to learn from this is that all these blue chip shares have a group of insiders who know more than what the market knows, despite all the financials they publish, despite everything. So there's a small group, probably half a dozen people really, who actually know what's going on. And those people will always trade on their inside information. They will always get out of the market if it's going to fall. And you can see that they started selling over here. This was the high point. And from this point onwards, they didn't allow the share to rise above that high. So they were offloading. Every time it went back up to 90 odd Rand a share, they offloaded again. It fell back, then rose again. They offloaded more. And finally, they probably overcame the market. So then they caused the share to really fall back. Even so, the positivism about Steinhoff was so strong that for the next 15 months, over this long period here, which is the right shoulder, the share continued to hang on to its value at around 55 Rand a share, but drifted downwards. And the insiders were probably still selling during this 15-month period. And then finally, of course, the news broke with the Viceroy report and the share collapsed. So those insiders have inside information. They will always trade on it, but they leave their footprint in the chart. And if you are an astute private investor, you can see that. You can see the signs that they are selling out of the share. The problem with the big institutions like pension funds, unit trusts, and insurance companies is that their analysts are completely fixated on the financial statements. But what if the financial statements are wrong? What if they are nonsense? What is your protection then? And you should bear in mind that these big institutions, in this final fall from 55 down to 5 Rand, they lost about 200 billion Rand. And that doesn't take into account how much they'd already lost when the share fell from 90 Rand down to 55. So they lost enormously. And you obviously don't want to be part of that process. All right, so what I'm trying to say to you is study the technicals. You can learn a great deal by just doing a little bit of simple analysis, as you can see that I've done here on the screen, and follow what's happening. Okay, and that will give you the inside track. You'll be able to see what the insiders have been doing. All right, now I'd like to just talk about a few companies. Tremerton, this is a small property company. But why it's interesting is because it's busy selling out of its properties and buying into the schools business, the education business. It already has 8 schools, and by the end of this year, that number should have doubled. So it's following in the footsteps of Curro and Adved. The only negative thing about this share, Tremerton, is that it's relatively thinly traded. So at the moment, there's only about 50,000 Rands worth of shares changing hands every day. And that's a bit thin. But we believe that in order for it to continue buying schools, once it's sold its properties, it will have to do some kind of rights issue, and that will make it more tradable. Anyway, we're just drawing your attention to it because Curro and Adved have done so well, and this looks like a share which is following in their footsteps. The next company I want to talk about is Equites. Equites is a real estate investment trust. But it is different than other real estate investment trusts because it specializes only in logistics and distribution properties. So warehouses and properties where they are warehousing and distributing product. And of course that is directly in line with the trend towards online purchasing. Consumers don't want to go to a bricks and mortar shop anymore. They want to buy something on their phone, get it delivered to their house or their office, and This particular real estate investment trust is investing in the properties that will make that possible. So it's not investing in retail outlets like shopping centers. They recently bought 100,000 square meter logistics property in Germiston, which has Simba as its major tenant with a long-term lease. And the CEO is a lady called Andrea Turisan, and she says that a wall of cash is leaving retail and going into logistics, reflecting obviously the new technology which people are using to do online shopping rather than going to particular shops and buying in the normal retail way. This company, Equites, in the year ended 28th February this year, had its earnings up 37.2%. And it's even doing well in the UK, despite Brexit, because it's focused on the area of property which services online buying, online retail. The third company that I want to talk about is Transaction Capital. Now, we have spoken about this company before, but they've just produced their results. It's a company which listed in 2012. And what this company does, it does two things. First of all, it's in the minibus taxi industry. So it finances, repairs, insures, and sells minibus taxis in South Africa. And it's the biggest company doing that in this country. And it listed in 2012. So that's the one side of its business. The other side of its business is that it is in the business of debt collecting. So it buys up people's debt for a fraction of the face value of that debt, and then it sets about collecting as much of that money as it can. So these are its two businesses, and you'll see both of them are really recession-proof. The taxi industry is recession-proof because it is the way that 70% of South Africans get to work every day. They have to use taxis. So this is an industry which, in my opinion, is pretty recession-proof. The debt-collecting business is similar. In a recession, like the one we're in now or entering now, companies use debt collectors more and more and more because they have to collect their debts. So this company has had a compound earnings per share growth since 2012 of 20% per annum. Compound. That's very, very good. And it's paying dividends which also have grown by 33% per annum since it listed. Compound. And again, that's a very, very good thing. It's recently bought a new portfolio for 2.1 billion rand. So that's a debt portfolio. And it paid just 404 million to buy 2.1 billion rands worth of debt, and it will now set about collecting that. Altogether, it has about 23.5 billion rands worth of debt in 254 portfolios which it's bought. And it collects every year about 3.6 billion rand off that 23.5 billion rand portfolio. So obviously this portfolio that they've just bought worth 2.1 billion, they paid 404 million for it. If they collect, say, 1 billion out of the 2.1, they'll make an enormous profit on this, an enormous profit. So this share, we believe, is becoming a diagonal. In other words, it's one of those shares that goes from the bottom left-hand corner of your screen to the top right-hand corner. In 2014, you could have bought the share for 470 cents. It's trading today for about 1975 cents. So it's a fantastic option. Finally, I want to talk about CarTrack. So this is another share that we really believe you should have in your portfolio. They do vehicle tracking and recovery. They have operations in 24 countries around the world, and they have a 92% recovery rate, which they claim is the best in the world. In the last 6 months, their subscriber base has increased by 21% to 961,000 subscribers. Their revenue, their turnover, is up 30%, and their headline earnings per share is up 15%. And this is the 6th year that they've had double-digit growth in headline earnings per share. 90% of their income is from debit orders. In other words, it's annuity income. They don't have stock, they don't have debtors really to speak of. So this is a debit order company whose expenses, their overheads, are paid before they even open the door at the beginning of the month, because they've got such a strong annuity income. This is the kind of share that will do extremely well on the JSE. So we're drawing your attention to a few shares there, which I'm sure you'll find interesting and that you should consider for inclusion in your portfolio. Ladies and gentlemen, that's what I have for you today. I hope you've learned something and found out some interesting things. Otherwise, I will see you again on the first Wednesday of July. And thank you very much for listening to me. Thank you.